Well, hi folks, welcome, and great to see all the pre-chat discussion, the pre-show discussion in the chat. Very interesting points already raised: politics, house prices, where to invest. Lot of stuff that we're going to cover tonight. I'll just put the pre-show on for a moment or two before I start the show formally and bring Damien in. Very important conversation tonight, I think, bearing in mind where everything is. We've got the election, of course, there in the background as well. We've got shenanigans on the markets. Our own market was down 2%. The US market was up quite strongly on Monday, having fallen dramatically the end of last week. So we're all over the place. Bonds going through the roof still. And interest rates looking as though they'll go up in certain parts of the world, although in China they're pulling monetary levers the other way. So we are in a very interesting state of undress at the moment. So it'll be quite interesting to see what Damien thinks about that and how he thinks about investing and whether to invest and what to invest in and what not to invest in. Very interesting conversation. And the good news is the doggies are in position. So before we go, I can just show you the doggy cam. There we are. So Meteor and Luna are in position. Luna being the far dog, Meteor being the near dog. So they'll be probably asleep most of the time. I might go and give them a little bit of a poke a bit later and see whether I can wake them up, but at least the doggy cam is working. Okay, well, I reckon that's probably enough time for people to come in. So let me take the pre-show off. I'm going to run the introduction and then we'll get going with the proper show. Stand by. Well, hello and good evening. Welcome to this live stream event on the 26th of April 2021. Martin North from Digital Finance Analytics here. Great to have you on tonight. And very important conversation. Damien Klassen is going to join me in a moment or two. Just before I bring him in, let me, as I always do, just remind you that we don't provide legal or financial advice on the channel. We do moderate the chat. This is as at the 26th of April if you're watching in replay. And if you want to get my attention or ask a question, use @WalkTheWorld. I'll make sure that I see it in my queue. We also have enabled Super Chat, which enables you to get your question to the top of the list if you'd like, or indeed if you'd like to make a contribution to what we do here. Greatly appreciated. We don't do this for profit. We do this because we think this is a really important conversation to have. So contributions are greatly received to help cover some of the costs of what we do. Enough said on that, I think. And without further ado, let me bring Damien in. Damien, hello.
Nice to see you again.
How you doing? Can you believe another month has gone by and the markets are still wobbly?
Yeah, volatile, isn't it? It's it's exciting. Been exciting times all month. So, but yeah, I do feel as if we're sort of coming to a head for a few issues. Let's jump in and we'll talk about it a little bit more as we go through.
Absolutely, and it is worth underscoring, I think, Damien, that there's a level of uncertainty at the moment that I'm seeing as I look out globally. We've got obviously Ukraine, we've got the bond rate issue, we've got the tech issue, and we've got the election locally. All those things. So there are lots of balls in the air at the moment, and I guess sometimes the question is it sensible to try and actually map out what's going on and try, or is it sometimes better to say, well, maybe it's a good time to sit on the sidelines and wait for the things to sort of go flop? What do you think?
Look, it's certainly tempting to do that. Obviously, I get paid to take a view on things, so it's obviously it's a bit harder for me. I think there is a part where markets have been moving so fast in recent times that if you have a sort of strong view in either way, you want to be ready to go. Like it's not something. So we often talk to investors who are comfortable sitting on the sidelines for a little while and waiting for a catalyst. And really, it's about saying, well, that's fine, but make sure you know where you're going to put your money and what you're going to do when you do it. So it's not a matter of you do get a pullback in markets where you get events, certain events happen. Is you sort of scratching around going, oh, I better set up some accounts now and work out how I'm going to transfer the money and go through, and sell down this and switch to something else, is actually have your game plan sort of preset. And that's, I think, not just that's not just for people putting new money in, but for people with existing money in the market, is actually saying, okay, well, if we do get a tumble in markets, what is my game plan? Is it to panic that time and sell everything, or have I actually got a game plan in front where I'm saying, okay, if markets took a tumble of 10, 20%, okay, this is what I'm doing. I'm going to be selling some of my bonds. I'm going to be moving into more equities, and of the equities, I want these types of equities or those types of equities, and that's really what you want to be setting yourself up before it happens, because it's in the heat of battle, it's a lot harder to keep a clear head. But if you've got your plan set out and this is what I'm going to do, you can always change that plan. But it's much easier to stick to something that's sensible if you've made your mind up before the event happens.
Yeah, and just to give you one example, moving money from a bank account into a trading account, for example, ready to trade, doesn't necessarily happen like that, does it?
No, that's right. There's different accounts will have, you might need to BPay, often takes a couple of days. You've got things like you might have limits, so you might have $50,000 limits or something like that. So you just need to make sure what are your limits to transfer, and all that type of stuff is actually just knowing that you've got the things in place, and if there's a lot of people have family trusts or super funds and things like that, you might need multiple people to sign on to places. It's just I guess the net effect for me is always saying, look, get everything set up, get a plan written out, and then you can always change it, but have that plan that plan and everything set up, ready to go.
So have a plan, and hope is not a strategy, as I sometimes say, right?
No, that's right. And look, I've run financial models on hundreds of different things. Look, I think having a financial model is a great discipline to have. But do I trust financial models? Absolutely not. They're only as good as the assumptions that go in there. But having said that, having a place to start, which is I have a financial model that tells me what I think this stock is worth. Now, something's just happened. They've had a huge earnings downgrade. Elon's just made a bid for it. Something's, whatever is going on. Okay, now I can, around that model, now I can make the adjustments. But as opposed to sort of just finger in the air and saying, well, it's better than what it was yesterday, and so therefore I should be buying it. It's actually saying, well, yesterday it was still expensive and now it's more expensive, or whatever it is. So, yeah.
Absolutely. Now, Cookie asked a question, which is probably worth exploring. Inflation figures come out tomorrow, probably going to be strong. The US is very strong. The UK is strong. New Zealand was not quite as strong as people expected, but pretty strong. I guess the expectation here is that inflation will be quite strong here too.
Yeah, I'm not going to put a guess on the number. That's sort of, but yeah, absolutely expecting it to be strong. It's interesting as well. We've obviously got central banks around the world who've sort of taken that view that now's the time they're going to start raising rates and normalising policy and inflation. They need to jump on inflation. Now, the Australian Central Bank has sort of been certainly behind the rest of them. They have been making noises. It's an interesting question now that saying, will we get a rate rise next week if inflation comes in strong and the central bank keeps talking the way they've been talking, is saying, well, they say they want to be apolitical, so they don't want to raise rates during an election campaign, but that's effectively being political, I guess, in terms of saying.
And they did do it once, didn't they? Was it the Howard election that he lost?
I think so.
Yeah, I think they might have.
I think that was the one.
Yeah, a couple of weeks before the election, they put the rates up.
Yeah, that's right. And
so
that's obviously had to. Yeah, that's right. And if they do, you can imagine there'll be the howls of outrage from various quarters of the press, saying that the RBA's got it in for the Liberals. Look, they've done it again. And so, but it's a look. I do think it's policy error to do it, but based on what everyone else is doing and what they've said they're going to do.
Well, of course, they'd argue we're being data-driven, data-dependent, right? Which is why they've been able to change from 2024. And it's interesting how if you chart over the last 6 months, how every time they brought the period in closer and closer and closer, and the quantum bigger and bigger. And it's interesting, just reflecting on this is the current ASX 30-day, right? 3.4% is their terminal rate over there in 18 months' time, right? And they're looking at very significant increases. Now, I know these are only market indicators, but if you trend this chart over the last 6 months, it's been going up and up and up and up and up, right?
And 4 months.
Yeah, well,
since the start of the year.
Exactly. Yeah. And I guess the question is, are the markets just too narrowly focused? Or are they actually effectively ahead of the curve? And it's interesting that, of course, we've got the same trend in the US, very similar charts, very significant rises. In fact, in the US, they're now saying we might even get a 1% rise next time the Fed moves. And the markets have priced that in, and I was listening to someone the other day saying, well, every time the Fed says this amount, the markets assume it's going to be this plus this, right? So it's almost like the markets are trying to outguess each other. But one of the things to understand is there's a massive now tension between what the US and the UK and New Zealand are all doing compared with China, because in China, they're actually going the other way.
Yeah, and actually, can we talk Japan just quickly, because I think it's related to the China, is that so Japan, and actually I'll go one step further back. Let's talk Australia first. So Australia came out and said, hey, we've got this 3-year bond target, we're going to defend it. And the market basically pushed and went, well, we don't think you are going to defend it. They pushed and the RBA basically let it go, and then came back later and said, okay, we decided not to. And so whereas Japan's come out and said, we've got a target, and it's for the 10-year bond, and we're going to defend it. And they have been. And what that meant is the currency's been smashed in Japan. And so that's then sort of got a bit of a flow-on effect, because they're a major competitor for China for a lot of these goods and services. And so it's interesting to see, well, the market is certainly testing the Bank of Japan at the moment. Yes. So they tested the Bank of Australia, and we surrendered and ran up the red flag, within a week. And then, which I think does make an issue for credibility, because one thing just turn around and say, we're going to keep rates low for at least 3 years. And then, maybe a year later, sort of go, okay, well, we didn't mean 3 years. We just sort of meant we'd keep it low for a while, and markets pushed us, and so we gave up. Whereas Japan's basically taking the other view of saying, no, we're going to keep rates low. We'll keep printing. If you want to push the Japanese yen down, then great. That'll help. Bring more demand, bring more more exports in. Japan will be able to produce more exports at a cheaper rate, and so then that's affecting China as well. And China's got this problem that. So everyone's got, all countries have this issue about the impossible trinity, they call it. So you can't control your interest rates and your capital flows and your exchange rate. You've got to pick two of them. You can control two of them, but then the other one you've got to let that one go up and down with the market. And so and China's sort of tries to control interest. They sort of try to switch between all three and try and control a bit of each. And so they have tried to control the currency, but one of the things they do let go every now and again, they let the currency sort of fall when the pressures on the other two become more extreme. And so and that's how we've sort of been seeing China play this at the moment is currencies where it's been where it's been starting to hit. They've got that issue about they're going through the whole COVID. Their vaccines aren't particularly effective against it. So and they've got this zero COVID policy that I think President Xi really has sort of nailed his flags to that mask. And I think a lot of talk within China. There's been a real narrative there that look, China's done a great job. All those Western countries haven't done a good job. We've done this great job. You've got a superior model. We've been protecting you. And so it's going to be very hard to reverse that. And so on one side, you can sort of go, yeah, they're sort of being successful managing to keep the virus down. But the flip side is at the cost of all these shutdowns and economic pain. And so then they've obviously got interest rate issues, currency issues, and so that's sort of affecting the rest of the world as well, and in particular Australia.
Yeah, absolutely. I was reading something today that's suggesting that somewhere between 12 and 15% of China's GDP output is now frozen because of the lockdowns.
Yeah, right. And what does this mean for supply chains? Does this mean that all these banked up supply chains in the US, is this going to give them a chance to flush themselves and to catch up?
Well, they're all queued outside Shanghai at the moment.
Yeah, that's right. There'll still be shortages, but I guess what I'm saying is all your ships, you won't have the ships sitting off LA anymore, and all these containers in transit across America. So that might solve that problem, but it might only be a short-term solve, because then all of a sudden there's a flood coming across from China when China reopens, and and all those goods and the orders that have been put through actually do finally make it. So,
well, I was reading something else from one of the government sources, and they were suggesting that up to 90% of our imports, consumable imports, are coming from China. Which is, if you think about it, doesn't make, that's probably quite close, because that's been the major source. So suddenly that's all turned off, right? Suddenly we can't get the stuff that we want to get, so that's a problem. And the other interesting point, just wanted to go back to the, this is the Shanghai Composite, right, which took another bath today. So it's way, 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 way down. It's at 2887. It's hugely down.
Yes.
And that's really a reflection that... the markets are beginning to say, well, hang on a moment, maybe this isn't quite what we expected to see. They did actually cut some of their rates, and they've reset the target range for the exchange rate between the US dollar and the yuan, but it's gone below that again. So it's not good.
No, that's right. And so, and they've obviously got that. And so the other third part of that was in the capital controls and how much money's coming in and out. They do have a lot of. They do want to sort of make sure that they're trying to keep on top of that. And so that's that's that part of saying that the markets will push, and that and there's actually one of the investment banks came out. I can't remember which one it was, but their theory was that that what the Chinese government was going to do sort of over the next little while was actually, yes, the currency would probably fall, but they were going to make it volatile. They're actually going to support it rapidly for a week or two here and there and really push it up, and then it might fall again, and then they'll jump in and do things as well. Basically to take away the idea that this is a one-way bet about, sometimes you get this extra pressure where markets are expecting something, they just keep pushing and pushing and pushing until eventually something cracks. And I guess the idea is that the Chinese government would be manipulating the currency to try and push it around the edges of those to at least try and flush traders out and get them out of doing stuff within the Chinese currency. So
it'd be interesting. I don't know whether this has flushed them out, but it certainly gives them a bit of a scare. This is the dollar yuan, right, which is now sitting at 6.54. And look at this run up over the recent times, right?
And so we're talking
6.3 to 6.5, right? I mean, this is a big move, and this is probably the most it's been for quite some time. In fact, if you let's change the scale and go back a bit longer. I mean. Okay, there were times previously when it was up at 7. That was in 2020, but that's a big move and a very significant move in the short term. So, very interesting question as to what does this all mean for China, and therefore what does it mean also for the trade structure. And two other points. If you look at what's happening with where the yuan is, some of the investment that was going into China is now flowing back out of China because the relative yields have actually moved around quite dramatically. And we also know that the Fed in the US is supporting Japan directly to help them with their keeping their currency in place, right? So there's already international flows going all over the place under the waterline, which isn't obviously transparent, but is actually part of this piping and infrastructure that we've got relating to the way that the finance market works.
Yeah, and plus, obviously the sanctions on Russia and China helping to buy Russian oil and other various products sort of around the edges as well. That's sort of all sort of one more factor that's sort of bouncing around in there, and what flows, I guess, from China are sort of effectively sort of proxy Russian flows, if you know what I mean, in terms of, yes, Russia's bought rubles, but converted into whatever.
Well, just quickly on Russia, of course, Russia has linked the ruble to gold, right?
Yeah,
which is an interesting little move, because that makes it sort of more like a petro currency than it was before, because of course it's now connected to the dollar. So that in itself, I think, is quite interesting. And the reason they can do it because they've got a lot of gold sitting in Russia.
Yeah, that's right. And the other thing is, I think we spoke last time on here about saying, my sort of take on, especially the oil side of it. I thought the gas side's a bit harder, but the oil side of it was that, look, Russia's producing a certain amount of oil. India and China are consuming a certain amount of oil every year. and that yes, it was hard to get the oil from Russia down to India and China, but there's clearly a scenario where basically rather than Russia sending its oil to Europe, it now sends it to China and India, and the Middle East, rather than sending it to China and India, now starts sending it to Europe. And so basically all the oil has to sit, on a ship for 2 weeks longer or 3 weeks longer. But it's effectively a similar amount of production ending up in a similar bit. And we are starting to see the oil, the first cargo load sort of started to hit, I think probably 2 weeks ago in China. So that sort of started to flow. There are some issues around, are there enough ships? And, there's a few sort of shorter term issues, but it does seem to be going in that direction very much. So I guess that's sort of that's an argument for oil price, ending up lower, that there's a short-term push while more oil has to sort of be sitting on ships for a longer period of time, but that, the production will just shift around the world. And as with most commodities, I mean, we saw that with Australia when China came out and said they're going to target Australian commodities and they weren't going to let them come through, is that most of them just ended up somewhere else. So, there's only a certain amount of barley in the world. The fact that China wasn't buying our barley meant that China was buying Canada's barley and Brazil's barley and wherever they took that from, whether it was Europe or the Middle East, that's where our barley ended up. And so, it's a similar type of argument with oil.
Well, I did a post the other day making exactly that point, that, the impact of the Chinese, restrictions on exports from Australia hardly had any effect, because we were actually able to sort of shift those elsewhere, and it just moved the pudding around, but it didn't actually change the pudding, it just moved it around, right?
Because they're commodities.
Yes,
yeah,
exactly.
So some things don't work. So obviously education, which I'm hoping education is not a commodity, but that's we'll sort of argue. I think some people would argue against me on that one. But there's not an easy source to replace all the the Chinese students that sort of came to Australia. But most of the other ones, commodities are very easy to switch around. Nobody really cares about it. And that's exactly what the position Russia's finding itself in, is that, it's hard for them to import certain things, IT sort of, and some of their knowledge-based economy, that's sort of gone and not coming back. But the commodity side of it, that's the oil and the gas to a certain extent is quite easy to shift around. The problem with the gas is if you don't have pipelines to where your customers are, that's obviously an issue. But the exit, commodities are ultimately, that's all. It's in the name. They're interchangeable for.
And Macron coming back, of course, in France, and wanting to essentially put pressure now on Germany to turn off Russian oil, and quite quickly. That can have another interesting, knock-on effect. But it's interesting. The WTI at the moment is actually at 98, right? So it's below the 100. So it has come off its highs of 128. And that's partly perhaps something to do with the demand downturn from China because of the lockdowns, and partly because, as you say, some of these supply chains are now sort of readjusting, and therefore the peaks may be off. But people in Germany are still very concerned about the impact, because they're saying that will cause a recession.
Yeah, no, it's and I've read a number of articles from others, in people in different parts of Europe, talking about how a dozen years ago Germany was explaining quite carefully to Spain and Italy and Greece about how you just have to go through some austerity and take some pain for the good of the European Union, and to yes, you might have higher unemployment and it might be tough for you as an economy, but for the good of the European Union, you really should do this. And there's quite a reasonable argument in the other direction now, saying, well, for the good of the European Union, maybe Germany should take time for Germany to take some pain. So but we'll see.
Boot on the other foot, isn't it?
That's right. And there are a number of German politicians, though, and particularly the party that's in power at the moment, who have some quite close linkages with Russia. Yeah. I mean, the ex-chancellor from Schroeder was sort of still on the board of a number of these big Russian companies, and makes $1 million a year or more from Russian ones. So there's it's not a simple it's not as simple as Russia, as Germany just deciding yes, we'll do it, because there's a number of people who have to sort of basically do a 180-degree turn, and they've admitted they were wrong in some ways, but nobody wants to admit their entire philosophy was wrong.
Absolutely. Well, it is a philosophical positioning, of course. Now, there's a whole bunch of questions in the chat. I might just pick up a couple of them because there's quite some interesting stuff, and it may lead us into some of your charts. There's this one here about how does Australia's credit boom not lead to a housing bust like what followed Greenspan's final years, which is, a way into it. If rates go up, what happens? And I know you've got some slides on that. And there's also a bit of a question of, will the RBA move or won't? Smooth Operator says, nice graph, but it'll note this talking about the rate. RBA is scared to raise rates, so how independent are they? Will they raise rates? Do they know that if they do raise rates, it could actually create mayhem in the property market, and are they going to actually be sanguine about it because of that concern about the property market, bearing in mind how much of the debt is linked to property? And this one from Fraser basically said rates need to increase by 3% to cause significant chaos in Australia. The average mortgage, 75,000.
I think.
Yeah, I think that's right. I wish it was. That could be after the crash. But no, the point is, though, people are highly leveraged. So I know you've got some slides on that. Do you want to sort of explore that a little bit?
Yeah, sure. So run a property model for anyone who hasn't seen it. We've got a property calculator. So it basically goes through and runs, looks at property valuations. And the idea behind it is saying, how do you actually value a property? So if you look at it, one way is to look at yield, and that's from an investor perspective. But that's obviously problematic as to that yield, over the last 20, 30 years, the yield has just gone down and down and down and down. And so, is 2% the right yield? Is 1% the right yield? Is 3% the right yield? There's not there's not a lot you can do. You can sort of put your finger on in terms of that. And the other issue, probably the bigger issue, is that houses are there to live in. So people like to live in houses, and if you're moving into it, you don't really think about it as yield. And so the two key ones I tried to look at is what I call the affordability measures. And so in terms of those, they're these ones on the left-hand side. And so what I look at is the mortgage payment relative to rent. So if you took out 80%, took out 80% and put down a down payment of 20%, at the prevailing interest rates, how much is your mortgage? And what you tend to find is that, say, in a market like Sydney houses, it goes somewhere between 100% and 200%. So basically, when your rent is basically the same as your mortgage, then most people in Sydney then want to buy a house. And when it gets to basically your mortgage is double what your rent is, then people start flipping back the other way, and house prices start to fall, and people prefer to rent. The other one is then looking at your mortgage payments to full-time wages. And so that's the first two columns. What I've done there is this is actually looking at it over time and saying, well, if I did a percentile where 100% was as expensive as it's ever been over the last 50 years, and zero is as cheap as it's ever been, where do all these different cities sit? And so you can see there, say Sydney, for example, on a mortgage payments to relative to full-time wages, and keeping in mind we haven't even had a rate rise yet, that's as high as it's ever been on that perspective. If you look at mortgage payments relative to rent for both Sydney and Melbourne, you're almost at the 90th percentile, so in the top 10% of most expensive ever. And just to clarify one thing there, that is interest and principal, right? Because that's the RBA, when they quote their numbers, they only quote interest payments. They don't quote capital repayments. Yeah, that's right. So do it on a 30-year mortgage, which, to be frank, 30 years ago, a 30-year mortgage probably wasn't that common. It was probably more 20 and 25-year mortgages. But, I think it's to keep things constant over that time frame. Yeah, it was on a 30-year mortgage. Some of the other factors I do have on there as well, property prices to full-time wages, which is sort of, can you actually afford a deposit? Now, they're all horrendously expensive. But, on the flip side, that's a one-off expense, and you can get, whether it's inheritances or the bank of mum and dad or whatever it is that actually gets you over that first part. I guess I look upon it as saying that's one measure which has some sort of difference, but I think the ongoing every single month you've got to, if you're making a wage and then you've got to pay it out as a mortgage, you need to, that needs to be a constant and ongoing, or if it's cheaper to rent than what it is to buy, will people flip and stop buying as much? And so, and you can see there are still some markets that are cheap. So Brisbane, Adelaide, Perth are still, maybe Brisbane and Perth units are still relatively cheap relative to where they've been. Adelaide's probably more sort of average. So that's one. I'll flip these one. This is sort of just looking then at, say, the mortgage rates. So, and so what I do on the mortgage rates is I use the mortgage rate as being the lowest of the 3-year rate and the discounted standard variable rate. And so you can see that even though we haven't had an official rate rise, because the RBA put on the cheap 3-year mortgages, that sort of brought down the average mortgage rate, and now they've lifted that again. So now your 3-year mortgage rates have jumped quite significantly, and now we're looking at sort of standard variable rates as to what I'm using. And so even though they've jumped, they're still at the 6th percentile. They're still basically almost as cheap as they've ever been at any other time in history. So that's your mortgage rates. And then I do real wages. Now we've seen some nominal wage growth, but we're still not really seeing anything significant in terms of the wage growth. Maybe that's coming. There has been a jump in rents, so that'll obviously helps to flow through to make it more attractive to buy a house if rents keep going up. But I guess the question is this a catch up for the big negatives we've had in terms of rent growth over the last couple of years, or is this like the start of this ongoing trend where rent's going to grow at 5% per annum now for the foreseeable future? I'm probably more into the catch up stage, but it remains to be seen. I wanted to highlight Brisbane in particular, Brisbane houses, where they've sort of suffered the largest fall, I guess the most rapid fall in affordability. So if you look at, say, mortgage payments to wages, it was actually relatively cheap a couple of months ago, and that's just rocketed up now to sort of sitting at almost in the top 10th percentile of where it's been. And then similarly for the mortgage payments to rent, were quite cheap, and now they're in the sort of the top 25% of where they've been. So I guess that's where things have sort of worsened the fastest, if that makes sense. Sydney houses is the other interesting one. So you can see the mortgage payment to median wages is now higher than it's ever been. So despite the no official interest rate rises, mortgage payment to rent is already at 173%. So basically what you're saying is, what that's saying is it costs you 73% more to rent to buy a place just in the mortgage payment than what it does to rent. And that's before you've had to pay all your extra rates and repairs and all that other type of stuff that goes into owning a house. So from that perspective, I guess you jump into the calculator and you can play around with these assumptions and make assumptions about where you think these ratios will go and what you think interest rates are going to do. And you can just see that makes a huge difference to the housing prices. And in particular, the one I wanted to highlight that it makes a difference to is I've got one in there using no debt and one using debt. And what you'll really see is that if you don't use any debt at all, often the outcome over a sort of a 10-year period is reasonable. So you get a little bit of rent growth. You've got a rent coming in, and even if the house price is going nowhere or even slightly backwards, the returns, at least it's not negative. So you're still doing all right. The problem is because people use so much debt, and if we're talking about interest rate rises, is that all of a sudden the debt can turn what might have been just an average or a little bit bad investment into a very bad investment. So, if you put down $200,000 on $1 million property, for example, and you don't need to see, straight away you've probably lost, 50 to 70 grand or something like that on your just on your stamp duty and all your entry costs. So you're already out a whole bunch. If you actually exit that at the end of 10 years, you're going to lose another bunch of that. So you're probably out, over 100 grand just in your entry and exit costs. It doesn't take much of a movement, and you can wipe out your entire $200,000 investment. over that time frame. So debt can never make a good investment. Can never make a bad investment good. It can make a good investment great because it sort of takes a 7 or an 8% return turns it into like a 20% return or a 30% return because you've got that extra leverage effect. But there's a lot of scenarios where you can see now where you might have got a 0% return or a 1% return if you bought it outright. But then if you use debt, you end up losing bucket loads on your on your investment. So that'd be the real thing. I sort of, anyone who's thinking about buying, jump in, play around with some of the assumptions onto that calculator, and just have a look at what you think is going to happen. You can change inflation rates. You can change what you think, where you think the mortgage payment to rent should end up, but the net effect you really see is that any time you get rising interest rates, it's very, very hard to see good returns for property.
Absolutely. And let me just share with you, this is from my model. So I'm looking here at the relative influence of housing affordability or house prices on various factors, right? And interest rates and credit availability are by far... Oh, it stopped.
Lost it there, yeah.
Yes, try that one again. Interest rates and credit availability are by far the biggest element in all of this. And that what that means is that the biggest impact to what happens in terms of affordability or not is what happens to credit availability and interest rates. Everything else, migration, government stimulus, just doesn't have the same impact on the overall. So it's the most powerful set of levers, right? And yet, of course, the Reserve Bank says, no, house prices nothing to do with us, despite the fact they set monetary policy. And APRA says, nothing to do with us, despite the fact they actually set the parameters with regards to lending, numbers as well. So whichever way you look at it, there's something fundamentally wrong in our government structure when the RBA and APRA both say, nothing to do with us. And then, of course, the government says, well, it's the state supply side issues. No. These are demand side issues, right? The demand side, credit availability, lending standards, and interest rates are the most powerful precursors to housing price growth or housing price falls.
Absolutely. And that's at, and we were talking beforehand, you're saying that I hadn't realised I was high, is what you said. I knew that there'd been some tightening, but I think you were saying between 8 and 15%. Was that?
Yeah. So I was talking today to a couple of mortgage brokers who are finding that the banks have throttled back their lending parameters, somewhere between 8 and 15%. Yep. So that means that people's borrowing power has already been reduced.
Yes, and then you get your interest rates where 18 months ago, or even probably 6 or 7 months ago, you could come in and borrow at sort of on a 3-year fixed rate and get close to 2%, and now you're talking about 3.7ish in terms of what you're looking at for a standard variable.
So there are some very cheap standard variables for lower LVR loans, but if you're not low LVR, you'll have to pay more. And if you're on a fixed rate, the 2-year and the 3-year and the 5-year are a couple of percent higher than they were just 6 months ago, right? So anybody who's got a fixed rate and then is going to have to reset it over the next period, whatever that period is going to have to pay a lot more. But yet what's interesting is if you look at the results from the banks most recently, they're all having margin compression. So effectively the cost of funds are continuing to rise. They're not paying much back to depositors. They're trying to actually keep some cheap loans to try and attract people, but the fixed rates are going through the roof. So this pincer movement of higher rates is not only going to have an impact on individual borrowers and the households, but also going to have an impact on the banks and their profitability as well. And that's something else to bear in mind, and presumably the Reserve Bank will be thinking about this in terms of financial stability. The APRA will have to think about it too, right? So makes you wonder.
Yeah, absolutely. So, and Australia's priced, you showed a few charts there of how you'd been, of all the interest rates that have sort of been priced into the Australian market. Now, my chart's a little bit out of date, but I've got one here just sort of showing that the expectations of other countries, and you can see Australia's actually at the top. So we're behind, starting below everyone else. But the expectations priced in is that the RBA is going to go further than any other country.
Yeah.
So, because I think we're almost at 3.5 now
I think, on that. I think 3.4. So this one's only got us a 3.25 sort of by the end of it.
Yep.
But so I guess I find it curious that the country that's the most over leveraged and the most reliant on these commodity imports and exports is the one where markets are currently expecting interest rates to rise the most, and also the country that's starting furthest behind all these other countries.
Yeah, because we haven't moved. We haven't moved at all, right?
No, that's right. Whereas most of these others have already started.
Correct. So New Zealand started; they're at 1.5% already. The expectation is that there'll be more as well. And it's interesting just noticing this is actually from ANZ, this is from Westpac, I should say, which showed the move, the terminal cash rate. In other words, where does the cash rate go to? If it went up to 4%, which is not a million miles from where that chart that I showed earlier on is, that would be the highest it's ever been in terms of the debt servicing ratio. Right? Even 3% would be pretty extreme, and 3% is definitely baked in, which shows you just how far. So Westpac argues, they can't do that. They'll probably go to something like 2%, maybe, but that's about it. But the international situation with regard to what other banks are doing, particularly central banks around the world, it's going to impact what Australia does. Right? We can't operate in a complete vacuum, not least because the exchange rate will get crunch in the process if we did that. So
which I've got no problems with the exchange rate getting crunched, but I think I actually think that's our solution.
Yeah,
that's our help to get out of this, because we'll speak a little bit, I'm sure, about the state of Australian manufacturing and other things. But one of those problems is that I do think the RBA. So my thumbnail sketch of the last sort of 20 odd years was the RBA actually was in front of the curve on the whole. China's going to be bigger, and there's resource things. There's this resource boom coming, and they genuinely did some good research in the early 2000s about it. And then I think they got too in love with their own research and sort of followed it through and went, yes, this boom is going to last for 30 years, just as the whole thing finished and the whole thing peaked. And they basically let the currency go too high. And because the currency went so high, all this manufacturing shut down, the car companies all left, manufacturing more than halved in terms of as a proportion of our economy. And that doesn't come back until you see exchange rates drop much, much lower. And so we've sort of rolled ourselves from a mining boom into a housing boom, and arguably a people boom in there as well, just to keep everything
that's
going.
My theory about quantitative easing in Australia for a long time was people-based, right?
Yeah, that's right. Called it quantitative peopling is what we did. As we sort of just fill the economy with more people to make GDP look bigger, even though GDP per capita was terrible. And so that's.
Do you want to show that? I'll put that chart up. It's quite interesting. That's actually the real household disposable income per capita, right? And from 2010 onwards, there's been no growth per capita, right?
Yeah, that's right. So what I've done is I've only done up to 2019 just to get rid of any of the things going on with the boom bust around coronavirus and all that type of stuff. So I was just sort of showing, this is what was our political economy. And because I want to talk about, putting this into context of what's the difference from an investment perspective. What should I do if Labor gets in? What should I do if the Liberals get in? And so I just want to sort of say that yes, we had all these recessions, but we really did. We did all the hard lifting and all the changes sort of in the Hawke and Keating years, or in the early Howard years. Of GST and all these a number of productivity gains. And then since then, we've just been cruising. It's all been about bringing more people in, and that as you can see, that no per capita income growth for just an extraordinary length of time. And that was why I think we had so much political instability though as well, because every election would show up and you'd have politicians telling people, hey, you guys have never had it go so good. Look how fast GDP is growing. And everyone's sort of going, just a minute, I don't feel like I'm having a good time. This is maybe I'm voting for the wrong party. And so, because no one likes to be told how great they're having it when they don't think they are. And then you go into, well, what actually got us through? And you go, well, there's this mining capex boom, and I just want to, that really saved us from recessions. And I just want to
highlight that was 6-7% of GDP. The Gorgon project alone was 5% of GDP, although it was spaced over like a number of years. But like this one project in one location added 5% to Australia's GDP over a number of years. It's just like the numbers were incredible in terms of what when you sort of take a step back and look at all that money that was coming through. That population change I spoke, we had this huge population surge around the financial crisis of almost 400,000 people, more than 400,000 people, that sort of really helped save your GDP in terms of didn't really help you from a per capita, but from a total perspective, the pie was bigger. Martin, your slice was a bit smaller, and my slice was a bit smaller, but because the total pie was bigger, they could say they're doing a great job. And then arguably that's what they've then said. Now it's just padding the stats, just going, well, let's just keep doing that to try and pad the stats. We're top 10 for GDP per capita, so we're a rich country. But we're a number 93. I sort of used the one beforehand, for economic complexity. So basically we have an economy that was as complex as Uganda and Senegal. I think we've rocketed right up the ratings at like another 4 or 5 measures now. Now we're vying with Kazakhstan in terms of economic complexity. So we just don't have a modern economy despite our riches. And then we've got this gas issue, and this is the one that I could go on for a whole hour about this, but I'll just do the thumbnail sketches. You can see us there. From 2015 to 2020, we went from a certain amount of exports, a relatively big exporter, to basically neck and neck with Qatar for the biggest exporter of LNG. And I think they were getting I think we were basically getting 80% less or 90% less in terms of actual revenue than what Qatar was getting. I think at one stage companies had, what was the percentage? I think it might have been 15% of GDP in tax losses, maybe even 20%. So like all these Chevrons and Exxons have got multiples of they've got these stored tax losses that just mean they're not going to pay tax for 20, 30 years because they spent so much on these projects. And so while it's great that we're exporting all this gas, we're just not getting the money from it. The average Australian is not benefiting from it. It's these foreign companies or a couple of local companies that are making all the money from it. And meantime, our local gas prices are up 2 or 3 times, which means all the manufacturing leaves. And as part of this, both sides of politics were involved, which is why we never hear about it, was that they put in this petroleum rent resource tax, which meant that it was this whole idea that when these companies make super profits, then the Australian government will do much better. But the net result of it really was that we hardly get any money for it, and that we're now facing these high gas prices on the East Coast. If you look at the West Coast where they did the gas reservation, gas prices are still sort of about half what you see on the East Coast. But, we've basically done it to ourselves. We've decimated our own manufacturing. We've done what basically no other country has done, which is said, yes, we'll open up our entire East Coast to global prices rather than taking advantage every other country that's got riches of gas basically says we'll make sure they reserve 10% of it or whatever proportion for local people first. And even Western Australia does that, and you see the benefit. But the eastern states, and it was a bipartisan measure to stuff that up. So we never hear about it. So yes, that's sort of where we were. And the other thing we did was international students. We brought in international students on a per 100,000 population. We're 3 or 4 times in front of any other developed country in terms of the amount of students we've brought through. And you speak to people. I think you've had Salvatore Boboni's here.
Yes, absolutely.
Yeah. So he's obviously, I think this might have been one of his charts, but he just talks about it basically being we're the cheapest, and so we're fighting on price, and so
not
if you
quality.
want a good, exactly, the first choice for a lot of these people is yes, I'll go to the UK or I'll go to the US or Canada, and then
if I can't get into there, then I'll still be able to get into Australia and just and it won't be that expensive compared to the other ones. So
yeah.
So yes, so that's sort of where we got to where we got to, and it's not a pretty picture, and it's not sort of good for individuals. It's good for a lot of companies. A lot of companies sort of very much leverage to this whole trade, and your house and whole economy. But and they're the companies that are the biggest donors into political parties. But it's not a sustainable model. It's not something that's going to last us, for years. And so, So the other one I want to highlight then. So I'll jump into preempt sort of what's the difference between the parties. From debt and government spending, I can't see any real differences. Arguably, the Liberals will spend a bit more. Certainly, they're certainly pork barrelling a bit more. But maybe Labor would spend more, in the longer term, I guess is the expectation. But so it's pretty hard to tell. On the RBA, there's no real difference. Foreign affairs, look, they'll both sort of say what they would have or should have done, and maybe Labor's slightly more China friendly, but it's pretty hard to see any real difference between it. Health, aged care, education, there's some difference in spending, but overall there's no reform. Childcare, Labor's targeting more lower income earners, whereas Liberals sort of opening it up a bit more to everyone. But again, in terms of quantums, there's no real big difference. I think the biggest one, the biggest one economically is the inequality side. I do think that both sides are sort of locked into this sort of drift towards inequality. On corruption side, Labor, I think, would absolutely do more, but how much more? We just don't know. I think their position basically seems to be they'll do more than what the Liberals did, but we just don't know whether that means a meaningful change or not. And then on climate change, though, we spoke last time about a lot of the price things. I think not blocking the states and just sort of not actively trying to block some of the changes will actually make a huge difference on that, because most of the economics have sort of hit the stage where companies are more than willing to take over, and it's sort of if governments aren't getting in the way. So, but on the corruption side, I just want to highlight that this extremely badly named CPI score, but it's the Corruption Perception Index from Transparency International, and you can just see that this is only the last 10 years. We've gone from basically the top of the range to bottom of developed countries, or towards the bottom of developed countries in terms of corruption. And the other thing over the last similar type of thing, but the trust in government. 10 years ago, in 2010, we were a dozen years ago we were number 4 in terms of trust in government, and then now we're below average, and sort of chasing Hungary, which the Hungarian Prime Minister, I don't know how much you've seen, but he's quite tightly tied to Putin, and sort of they have active protests about the amount of corruption that's going on in Hungary, and their issues with that. So we've certainly gone from top of the range to we're heading quite closely. We're certainly below average now, and heading in the wrong direction. And so, do I think these things matter? I think from year to year they don't really matter. But I do think there is a tipping point at some point where Australia goes from, yes, it's a great place to do business, and without the corruption, you can win contracts on your merits and all that type of stuff, to lumped in the same sort of categories as some of the more corrupt countries, and the expectation is you have to basically pay off the government through whatever means, whatever means you can backdoor through the donations through the government. And that's where companies stop putting things into Australia, and they start going, well, I've got a choice. I've got setting up in Asia Pacific. I've got a choice. I can put it in New Zealand. I can put it in Japan. I can put it in Singapore. I can put it in Australia. I'll pick Singapore because at least I know they're, on the corruption side, they're better off, or they'll pick a country that's, New Zealand or something like that, where they feel as if they'll get a better outcome. Now, I don't think we're quite there yet, but we're certainly none of those trends, are headed in that right direction. And so, and I think we're starting to get into the dangerous territory now.
And what's interesting, of course, is that almost none of that data is being actively debated as part of the campaign.
No, that's right. Absolutely not. It's like,
Which, I mean, I find it quite surprising that, they don't want to talk about this stuff. That's because they're both on the same page, right? They don't want to create any light between them.
Yeah, that's right. I mean, I think Labor wants to be whatever the Liberals are minus 5%.
Yep.
And that's just now I'm better than. I just need to be. It's a bit like the story, the two hikers out. And they see the bear coming, and it's like, well, I don't need to outrun the bear. I just need to outrun you. And so as long as that's the case, it's saying, well, so from an economic, so getting back to elections. So what does it mean if either party gets in? Look, I don't think it makes much difference at all in terms of from an investment perspective. Yes, there's slight differences between them. Hopefully, we'll get enough independents or other people involved that want to change the corruption side that they can reverse that. But either way, from an investment perspective, I'm treating this as pretty much a wash between the two.
Yeah, well, I've done some analysis around housing and a few other areas, and there's almost nothing between them. And what's interesting is that neither of them want to talk about any of the things where they might be different. I mean, other than those little selected areas, a bit on healthcare on the Labor side, a little bit on defence and on, our borders. Yeah. But that's all just, high-level stuff.
It's flavours. It's like, it's not saying, we're gonna feed you, vegetables and health foods and we're going to give you ice cream. It's like both parties are saying, we're going to give you ice cream, but we're going to be vanilla flavour. Oh, no, we're going to be strawberry flavour. It's like, you're still getting ice cream. You're not getting the health foods.
So I guess the interesting question then is, with the election then being not a non-event, because it doesn't make much difference, right? Given the international situation with Ukraine, with those interest rates going on around the world, what's your perspective from an investment perspective at the moment? Cautious, not cautious, waiting to see what happens? I mean, because there are a number of people who are saying the amount of uncertainty is massive, therefore the best thing to do is wait on the sideline and see how it plays out. There are others saying, no, you're missing an opportunity because there are still value opportunities milling around in the middle of all this. And I don't know which the right answer is.
Look, nothing's ever 100% certain. There could be and so, to position your portfolio into 100% equities or 100% cash or whatever it is for me making more of a, you're basically not acknowledging that things can come from left field and, whatever it is, technological breakthroughs or huge influxes of cash from governments or all these different things can go on that can change things from what you expect. My baseline is that yes, we try and treat things as to where they're headed, and the trajectory and inertia is this great force that's going to drive things in a particular direction. And to me, the inertia at the moment is very much driving in the wrong direction. You've got to take one of two views on inflation. One is that inflation is, we've spent too much money from governments and inflation's now, they've lit the fuse and the whole thing's going to explode and we're headed for stagflation and the genie's out of the bottle. There's no putting it back in. Inflation expectations are now going to be built into economies for a number of years going forward. So that's sort of one end of the spectrum. But the other end of the spectrum says, well, yes, inflation's high, but most of it's sort of either driven from supply chain or a lot of the energy side from and the whole situation in Russia, and that it's all about the shortages and the lockdowns and people, a mixture of governments, but then supply chains not being able to catch up. So it's more about the supply than it is the demand. And so if that's the case, and we're going to smash demand back down to the level of supply, then we've had problems getting demand up over the last decade, and now we're about to smash it down to levels to meet this weak supply. There's quite possibly deflation on the other end of it. And as we see, the Chinese property markets continues to slow. China's now going into all these lockdowns. You can easily paint a picture where we get deflation at the other side. And so yes, we've had this big run up in inflation, but coming out the other side, you get this rapid sort of push down the back end of that curve, and you end up with seeing prices fall. And I think I'm certainly more on the second case, more that it's not embedded, and a lot of this is supply chain driven, and Russia's made it worse, and there could be another event behind it that makes it worse again. Quite possibly, it's going to be the lockdowns we're seeing in China is going to make it worse again, and even more supply chain disruption. But having said it, that's still just it's one more supply side disruption. Smashing demand down to a lower level is not going to fix those supply issues, and so yes, that's where I'm sort of positioning my investments around that. But I haven't got 100% certainty. I know there's lots of other things that could crop up. And so it's about saying, well, let's run that path where we're sort of tilted in that direction, but we're not sort of taking 100% bet on it. And then as events unfold, we can sort of start adding more to that view or less to that view as as we see events unfold. And I think the interest rate side, that's the one I'm certainly looking at the moment. I guess I'd characterise our position as saying, last year we spoke a lot about here comes this inflation. We think it's inflation. We think it's a commodity. An inventory super cycle was what. And there's a bunch of other reasons why we're going to see this inflationary boom. And so we sort of shortened up all our yields in our bond portfolio with the view that that'll protect us as we saw interest rates rise and this inflation got going. So that was great for the initial part. Then we went, you know what, we've hit sort of 2%. That's probably enough. Now it's time to go more normal, and yields have flown a lot further out. So we obviously went way too early on that. But these things are sort of a pendulum in my view. And so the pendulum was too far on the short side, and now it's swung too far on the long side. There's a time to start picking up some of these bonds. And I think we're getting close to that point where you'll actually make some money as the pendulum swings back towards that sort of point of that sort of central point where I think we'll end up. So not quite sure we're ready to do it right at this minute, but we're certainly starting to pick away at that and to start to head towards that trade.
And it's interesting because the bonds, of course, continue to move higher. Obviously price and yield move in opposite directions, it's pretty much universal. I mean, Germany is now back into positive territory, right? Having been negative for quite some time. The US 10-year is knocking on 3. Even in Australia, they've gone up significantly higher than a lot of people expected, right?
And the Australian bond yields are higher than basically anywhere else in the world, developed world. We've got some of the highest bond yields anywhere, and so we're pricing in, as you saw from those charts before, Australia's pricing in basically the best economic recovery ever, and a lot of that's based on commodities. So that's where it's all around. Okay, Australia basically has very similar commodities to what Russia has, and so therefore, if Russia's been sanctioned, then Australia's going to be the one that benefits out. So. Whereas our take is, well, they're commodities. They're going to get moved around the world. China and India are both trading with Russia openly, and they're just going to consume a lot more Russian wheat and a lot more Russian oil. And gas is a little bit of a different issue because it's hard to get there. But there's we think things will move around, and it's more about everything will just travel a little bit further.
And just on the bonds, this is the current 10-year Aussie bond, so we're at 3.08, so we're over 3. And if we then compare that with the US 10-year, that's at 2.789, right? So you're right, we're higher than the US, and even the the German. The
German, just about everywhere.
Yeah, Germany is just over the zero, right? Which it didn't used to be, but it is astonishing to look at the Aussie bond situation.
New Zealand, I think, which, as you said, New Zealand's already done about a bunch of rate rises. I think they're slightly in front of us, maybe.
Yeah, I think last time I checked. But
it's they're basically the only country that's there. Every other one is. It's pretty much below us.
And the point about that is that it's not just the 10-year, right? So, I mean, the 2-year is often seen as a bit of a proxy for interest rates, right? So our 2-year is sitting now at 2.367, right?
Well, yes. So the other thing, though, what's interesting here is from an international perspective, one of the things people look at is what's called the steepness of the bond yield curve. And so basically the 10-year minus the 2-year is a very common one that people look at. And what's been happening is the Australian bond yield curve has been steepening, which basically usually means good things are coming. And the US bond yield actually inverted recently, which means look out, there's a recession coming. And so what we're seeing is, compared to the US, is a complete divergence in terms of the steepness of the bond yield curve. So one side we've got Australian bond yield almost not quite as steep as it's ever been, but certainly right up there in terms of the steepness, as opposed to the US, which is in effectively pretty close to recession territory.
Yeah, and those inversions come and go. So the 530 and the 210 in the US have happened quite recently, and of course then it sort of reversed again. So, is it a signal, isn't it? You can read different people. Some say this is a very strong signal. Others say, well, there's a lot of other reasons this time why it might not be, all the quantitative easing, etc., etc. But I do think this difference between the Australian bonds and the US bonds in particular are really worth understanding, right? Because it does signal something quite important.
Yeah, absolutely. And for me, that the key things it's signalling is a commodities boom, is an expectation of commodities boom. Yep. And I do want to be clear that, in my view, what we've seen to date is a prices boom in commodities. We haven't seen a volumes boom. And that's, to me, a commodity super cycle is we see, 50% more production or 100% more production in some of these commodities. And that's what we saw in as the rise of China, that's what we saw. What we've seen, over the last year or two has been a prices super cycle, not a volume super cycle. Volumes have basically been flat or even down for, some commodity shortages due to supply chains and all the various factors going on. And so, that's from that perspective, do I look at these and think, well, the oil price is $100 because nobody's willing to produce oil at $100? I'm like, absolutely not. People are willing to do it hand over fist. The iron ore price, look at $50. There is bucket loads of iron ore at $50, very profitable, and it's sort of closer to $150.
Yeah, there you go. So, there's the iron ore fines at the moment sitting at 154. But I just want to underscore what you said just now, because it's really important for you to understand, right? We've made more money, but we've made more money not on bigger volumes, but on bigger price.
Absolutely.
Problem is that price may not be sustainable. Right? And it's interesting that Treasury, when they do their forward budgeting, always take the forward price way down, because they have to say, well, it's most likely it'll come off again. Right? Now, it hasn't so far. But if demand from China goes away because China economy, continues to sort of freeze up, it could well then be the trigger of a fall in those prices. So it's not volume-based, it's price-based. That's really important to understand.
Yeah, that's right. And while I'm talking, I'm just going to see if I can bring up a long-term chart I've got some of these. I love to look at all these commodities on an inflation-adjusted basis. So what I do is go back and say, actually, let's grab a website, might be easier. Is go back and say, let's take 100 years of these commodities, and let's look at how they go under the if we adjust for inflation, because most commodities actually fall over time once you adjust for inflation. And so, sorry, let me just. I may or may not be able to do that live. Keep going, Martin, with your questions.
That's fine. Well, that's good. So I'm not showing your screen because I think you disabled it. So, so there's an interesting question that came in. I just want to pick this one up because it's quite an interesting one. This is from G Bun. What percentage deposit is needed to negotiate a better deal for a home loan? That's a very interesting question. The answer is it depends, like a piece of string. But generally, 80% and above, you start paying more. At 90%, you definitely pay a lot more, and you have to think about lender's mortgage insurance as well. So, but it does depend on overall income and other things too. So there is no silver bullet in terms of trying to answer that particular question. What I'd suggest you do is to look at something like CanStar that actually has all these different types of loans with different LVRs and things available. But generally, the bigger the deposit, the better able you are to negotiate. And certainly if you've got a 20% equity in a property, you have a huge amount of additional leverage when it comes to negotiating with the bank. The other point to make is that don't just necessarily shop around. If you're with a lender now, go back and talk to the lender again, because they'll often renegotiate as well, because it's cheaper for them to keep you rather than actually them having to recruit somebody else instead. So hopefully that might help that one. And there was another question from earlier on, which I'll just pick up as well, just while we're dealing with this, and that is this one here. Let me just try and move my pointer down so I can get it. That's one there. So this is from Cross-Stitch Ange. I mentioned the RBA was quoting interest only. Yeah, so on some of their charts, on some of their ratio charts, they talk about the interest payments to income. But the interest payments is only the element that's servicing the loan. It's not actually the total monthly repayments on the mortgage, right? And so whilst they can claim that the interest payments have gone down because interest rates have gone down, the actual total repayment that you're making is a lot higher because the average mortgage is a lot bigger than it used to be. And so in a way, they sort of position their charts quite comfortably just to support their particular view of the world, and doesn't necessarily give you the complete picture, right? And in fact, the truth is that most people, because they've got bigger mortgages and are paying down a lot more, their repayments are 30 to 40% of their income. So that's what I was getting at. So the RBA is not incorrect in what they're saying, but it's just a particular way of looking at it. So that's answering that question. All right. Did you find that? Did you find that?
Yep. Yeah, I've got that chart. Yeah.
Okay. Let me just bring you back up then. Hang on a moment. Let's see whether I can do that. Let's just go here, go here. Yeah, you just need to go full screen, or is that the best you can do?
Did I? I think it might be the best I can do. A short notice.
Okay.
I've got another one to show. So so this is the iron ore price, the real iron ore price. So basically, adjusting for inflation over a long period of time. So you can see it's 100 and something odd years. It's basically always under $50. We had this mining boom in the late 60s, where early 70s, where it sort of shot up to $80 a ton, and then came back down again. And then we've had the big rise. And that was actually, a lot of that was the rise of Japan. And then we've seen the rise of China, this next big boom. The first one was the rise of China, and then the latest one, which is this, the rocketing up. So, and you can, just from looking at the profits of the companies, you can see that they're very clearly very happy to make money at $50, $50 per ton long term. And then there's a similar one on copper where, similar. This is so I'm doing this dollars per ton, and just sort of showing that again. That's that where we are at that sort of $10,000 mark is historically has been sort of that's the highest. It doesn't often come down. It's often well below that over time, and that the real prices are sort of the real long term prices. $5,000 or $6,000, roughly half what we are at the moment. There's enough copper out there and demand and all that sort of stuff to bring on at that levels. And the argument that electric vehicles are going to use a lot more copper than and that's why you should be buying. Look, there's some truth to that. But the thing is, electric vehicles just aren't a big part of the copper use. They're like 10%, and so even if you doubled or tripled that, the amount of copper you need for vehicles. Over the next, say, 20 years, you're talking about 1% per annum more copper that's needed. It's just not a big number. And again, even with the solar and all that type of stuff like that, like you add up all the actual amounts you need, it's actually just not that much. So a reasonable growth of a couple of percent per annum would easily solve the copper needs for a market that's sort of moving to electric vehicles, electrifying, using solar, all that type of stuff like that. So it's one of those grain of truth behind it, but it's been pulled way too far.
Funny that. Yeah. I want to put this up. This is from George. Has anyone bought a solar power bank? Is it worth it? Now, the reason I've brought this up, because I know that, Damon, you've been doing quite a lot of modelling in terms of solar power and what have you, right? I looked at this a little while ago, and I realised that the economics of batteries attached to solar power didn't make any sense. The solar power itself made a lot of sense, but not the power bank. And even today, I'm a bit skeptical as to whether it makes any sense at all. Have you looked at the battery element within solar power?
Yeah, absolutely. I'll start with the pre-war calculations. So this is I've got a few, see if I can show this chart up on there, Martin. I'm not sure if I've got it. I've got this yellow line you can see, which is utility solar.
I'm on your spreadsheet at the moment still, so you need to.
Right, am I? Must have to stop that sharing and start again. Maybe I'll. Let me share this one. I'll go back on the slide. How's that?
Yep.
Okay. So this is the price of a utility solar. Is the yellow line versus wind and coal and gas. And so you can see this is all pre the Ukraine war. So you can see that's sort of all coming down. And then I've got what I call utility solar plus battery with partial shifting. So basically getting a couple of hours to get you sort of through that the night. And then the solar plus battery with the full shifting. So getting you all the way through the night as well. So that's on the pre-war. Then you look at and actually keep in mind this isn't retail. So this is the utility side. I do some retail calculations as well, which can't bring up on screen, but I know what the numbers roughly are. So then you say, well, what happens though if we start using different prices? We actually look at because we know that there's a levelized cost, which is before fuel, and then how much does the fuel cost? So that's sort of old natural gas prices. You're paying sort of 2 cents for the plant, and then another 2 or 3 cents for the fuel, and you ended up the overall cost you 4 or 5 cents a US kilowatt. Now, at current natural gas prices in Europe, the natural gas is costing you 20 cents. So it means that your solar plus battery or your utility solar plus battery is now well in the money compared to, and it's all about that cost. And then similarly with coal, coal's less sensitive to the price of the actual coal. There's sort of more in the upfront cost of the plant and less in the fuel costs. But at current coal prices of sort of $200 or $300 a ton, you're again well in the money in terms of what you're looking at. When you go to solar from a household perspective, the issue is the issue of the batteries is batteries are still marginal unless you're really using a lot of power within it. So they're still, I'd say that they're basically at the sort of break-even-ish point. If you make the assumption the costs are going to keep coming down like they have done over the last few years, then they start to move into solar plus batteries start to make more of an issue. And if we see prices go up, so if we see that the coal prices stay where they are and natural gas prices stay where they are, and we see that energy prices have to go up another 20% or 30% to cater for that, then batteries all of a sudden becomes a lot more effective in terms of that. But there's also this decent argument that over the next year or two, we probably will see a stalling. So we saw those prices come down quite rapidly over the last 10 years. Given the massive demand we've got in Europe now, because they all want to move off Russian gas, and a lot of government-sponsored subsidies and everything they can do to get their populations off this Russian gas, is that quite possibly there's going to be this scarcity issue that keeps solar prices high for a couple of years. But I do think the underlying trend of that, we're going from solar units producing 1,000 a month to producing 2,000 a month to producing 10,000 a month, and that price drops alone just from doing more volumes. That trend's still there. It's just hidden because there's this massive demand, which sort of, and our supply is not equaling out. But solar is a commodity product. It's not it can be produced by a number of companies, and there's going to be more and more people doing it. We had somebody on our podcast the other day, he's sort of an expert talking about saying, once you've actually got the solar wafers, there was a factory set up in Adelaide, and it took less than a year to have the whole thing up and running and at full tilt during the pandemic. And so, even building the factories is not that big of a task for that side of it. And the solar wafers, if you're building the latest and greatest ones, the process is quite complicated and can be more expensive and need specialized machinery. But if we're producing the ones from the last few years compared to the work that needs to go into some of the higher end ones, it's actually quite a basic process to produce those as well. And so very much a commodity product. As soon as they can scale up to the level, they will. And so from my perspective, there'll be this underlying cost dropping trend that we're not going to see for a few years because of scarcity, and then we'll come out the other end of that, and we'll just see some quite sharp drops again, I think, in those costs, and that then opens it up to, I think, a lot less volatility in fuel prices. It'll actually be a great thing overall because you'll hit that level where the coal price or the gas price going up and down will no longer influence the price of energy, because it'll be about that solar plus battery cost that sort of determines the upper end of the prices.
Yeah, very interesting. Well, I think we've probably answered the question quite well, but I'll make one other point, because we've done quite a lot of work here to figure out the best configuration for solar panels, and we've got trees, and the trees actually cast quite a shadow across the property later in the afternoon. And what you then discover, if you're not careful, is that the solar power output is actually regulated back to the power from the least powerful point on the roof. Right. So as one or two panels essentially go into the shade, the whole power drops, and you have to have a much more complicated management process and system to be able to actually still extract the power from the rest of the solar panels. Now, interestingly, 4 or 5 of the various people that we spoke with, none of them actually recognised that. Only one did, right? But as soon as I asked the others about it, they all said, well, yeah, but it's true. But, so my point is, there's a lot of traps here. There are traps also relating to the replacement of the batteries and the cost of the replacement and the guarantees and how long the guarantees last relative to the replacement cycle. So there's a lot more to this than I think a lot of the people who are flogging this stuff actually recognise. So again, I'm a little bit cautious.
Yeah, absolutely. I guess so. I would say anyone who's building something new, I would seriously consider, do you need gas at all? Because I think if you do the calculations on the, if I've got solar and I've got batteries and running, then do I have, and I can avoid that quarterly gas disconnection charge, then all of a sudden there's that makes the economics look a lot better, I guess, if you can avoid some of those costs.
Absolutely. But again, do the homework is what I think I'm underscoring, right? How often do I say that?
Absolutely. Absolutely. And the other thing with a lot of this as well is, like when you look at these, you're like, oh, okay, so all these costs keep coming down, therefore all these solar companies are going to be great investments. And you're like, no, they haven't been great investments. No. There's too much competition. It's a race to the bottom. Yep. Chinese are willing to produce at much lower prices. Yep. You're like, oh, what about the solar farms? They must be this great investment. You're like, well, the problem with a solar farm is you set one up today and it's profitable based on, usually they're profitable based on the economics you put in. But somebody builds another solar farm next door to you next year, their costs are going to be lower than yours because they've just built them with the latest panels, which are slightly more, efficient than yours, and, that might have been cheaper or whatever it is. And so the lowest cost provider is always the guy who just built one yesterday, rather than the person who built one 10 years ago. Yep. And so, so there's sort of that, you've got that issue of saying that it's, I think the technology is going to be fantastic for society as a whole. It doesn't necessarily mean the companies involved in it are going to be great investments, which is, always a trick as well.
Exactly right. And just to reconfirm, microinverters was exactly the point. So, but that's a more expensive route than some of the ones that are on offer. Hence the need to do that. And there's some interesting. Some people are saying, I've actually managed to make some savings on it, because I think you can. But all I'm saying is, it's not as a lay down mosaic. There's a bit of work that needs to be done.
Well, and the other, while we're talking, I should give a plug out to David Morgan from Iron Matrix, and so he runs a company that they make the whole house out of solar panels. And so basically their insight was that actually the price of a wall is now more expensive than the price of a solar panel. So if you put the right steel framing and everything like that, you can make your entire house out of solar panels, and you have your whole house generating electricity. So yes.
Fascinating. Well, we've got 5 minutes left. There's a whole bunch of things we haven't been able to cover on the questions tonight, but let me just sort of try and shape the conversation back to a couple of issues relating potentially to how Ukraine may play out. Because, of course, one of the unknowns in all of this is to whether, in fact, this conflict is going to continue and escalate, or whether it's not going to continue and escalate. In other words, whether it's going to be contained or whether it's not. Do you factor that into your strategy at the moment in terms of your investment portfolio, or is it just too far over the hill to be able to actually, make a position or make a judgment on it?
Look, it's certainly something. It's certainly something we're keeping an eye on and keeping abreast of what's happening. The net effect from an economic point of view is, the 11th largest economy in the world has attacked the 57th largest country in the world. It's actually not that big of an effect overall, like when they take the globe as a whole. But it does make a big difference when you start looking at the geopolitical ructions that's happening in terms of sanctions on Russia. China siding with, how much are they siding with Russia? What does that mean for China in terms of their designs upon Taiwan? What does that mean for China in terms of companies who are deciding? We spoke a lot about offshoring in prior ones, about saying a lot of companies took all their production, put it all in China, and then the pandemic hit, and then there was this first we had Trump with his tariffs hit, then we had the pandemic hit, and a lot more thinking, well, maybe I'm actually better off with factories in the US or factories in Australia and running them off robots, and actually I can get the cost down to pretty similar levels to what you'd find in China. And then you add in the whole Russia situation and supply chain issues, and that makes that decision that much more likely. Now we add in more shutdowns in China, and we haven't really seen the effects of that, but we're certainly, they're coming over the next month or two. We're certainly going to see the effect of the lockdowns that happen in Shanghai and quite potential the lockdowns that are happening in Beijing as well. And that's just one more thing that's going to move, more offshoring. So we've got a few companies in our portfolio we think are picking up from that, and we think that's a trend that over the next couple of years is going to play out. Whether you make money on it, right this minute or not, but I think there are certainly companies you should have your eye on and be looking for those companies that are going to benefit from that sort of re-onshoring.
Very interesting, thank you. Yeah, so much to watch. Right. I think the next 2 or 3 months will be particularly interesting. RBA will probably lift the rate. I don't think they'll lift them in May. Probably they'll do it in June after the election. I think they're too politically sensitive to do it now. I think inflation will come out quite a lot stronger than people expect, and that will be an extra incentive for the Reserve Bank to move. And my own sense is the election will probably end up as a significant proportion of unaligned votes, in other words, small parties, because I think neither of the main parties is actually really capturing the imagination or showing a vision for the future. And there are a number of people that I'm sort of listening to, and a lot of people saying, well, there's no difference. Why bother, right? So, and then, of course, the international stuff, the Fed will put rates up. I wouldn't be surprised to see 50 or 100 basis points in the next couple of months from the US. New Zealand is looking to put rates up again next time around, according to the latest analysis there. So rates are going up. Interest rates going up means prices are going to come down, so home prices probably a bit weaker, and we're seeing that already in the markets here with more prices being cut and significant supply. So interesting times, Damien.
Yeah, absolutely. We keep on saying, I think we've said the last few times that this is as uncertain as it's been for a long time, and hopefully by next month things will have cleared up a little bit more, and
seems every time we say that, there's another 3 issues crop up just to make it even more complicated. So I'm not going to avoid saying that this time. It'll be more complicated next time we speak.
But, it's like the old juggler's act, right? So we're throwing all these balls, and then somebody throws another one in. You've got to try and catch that one as well, right? Which means the uncertainty level continues to rise. But that's why we have to run these shows, and I reckon by the time you come back the end of next month, there'll be a whole new ball game.
Yeah, and I guess for my tip, I don't have any major issues with what you're talking about there. The thing I think I'd keep watching is what's happening in China. I think that's actually going to be that's what's really going to drive markets, certainly in Australia and probably elsewhere as well. Because if you get if these rolling shutdowns, which are sort of making a reasonable effort on a reasonable dent into China's production, if that keeps going for months, which at the moment it's hard to see how it won't, that's really going to start putting a dent into the rest of demand for the world. It's going to make more supply chain problems. It's going to cause more short-term issues in terms of inflation and things like that. That's really where, if I was going to pick a spot, where's the instability going to come from that could see the markets turn down? That's my sort of number one pick for where it is. I think what's happening in Russia and the Ukraine is pretty much baked in, unless it goes, let's say you start seeing the use of nuclear weapons or something like that. I do think that whether it gets bogged down or you see some more gains by the Ukraine or more gains by Russia, at the margins, not going to make a lot of difference for markets. I think without it going nuclear, I think largely that's all priced in, and the shock is no longer there. But I do think there's you can see some shocks coming out of China in terms of growth. That's where the most danger, I guess.
Well, that's certainly where I'm focusing at the moment. I've made a couple of shows on China recently, and I'm going to do more because I don't think people comprehend, one, how linked our economy is to China, and how dramatically that could change if, in fact, the China thing fell off a log. But also that point I made earlier on about the net investment now coming out of China rather than going into China because of the movements in the relative exchange rates and interest rates. That's quite profound. So, and of course, we've got the property situation in China as well. So there are some very important leading indicators.
And so, and on the property side, I mean, my take's that the amount of commodities that go into that property sector is it's the biggest consumer in the world of commodities. And so, and we've seen things fall from, come back from the massive highs we had over the last couple of years, but we're still not even back to sort of, 2012 levels. The property sector was running hot in China, and we're still not down to those levels. We'd have to fall another 20, 30% just to get to the levels where it was already running really hot.
Yep.
So if they're genuinely serious about rebalancing that side of it, and I do think they are, then that's got a long way to go still. And that's a huge, the flip side is if they change tomorrow, if they turn around tomorrow and go, you know what, things are pretty tough, we're going to have to put off all these property reforms for another 5 or 10 years, it's back on, no more 3 red lines, then iron ore is back to $200, $250, God knows where it's going.
Yep.
And it's all on for Australia. So, I think that's your, that's your part about saying you're 100% in equities or 100% not in equities or whatever it is. That's your, I do think it's headed down, but you could see, the Chinese government could try and turn around and just throw the kitchen sink at it.
Well, we'll be ready to watch and see whether the kitchen sink lands and how it impacts, and we'll do it again next month. Thank you very much, Damien. Really appreciated your time tonight. Very interesting conversations. The chat was appreciative too, and look forward to the next one. And just to say, if you want to find more about the services that Damien provides through the Walk the World Fund, just go to walktheworld.com.au. It's all in there. Damien runs a portfolio of funds that actually are doing not bad in the current environment, actually still hanging in, right? A few ups and downs, of course. But you're still there and still looking at the markets and still making calls, which is great. And appreciate all the insights that you share and all the time you give to the channel here. So thank you very much.
Thanks, Martin.
Great. I'll take you offline and I'll just close the show. See you later. Right, so there you go, folks. I hope you found that useful. Very interesting conversation. Always worthwhile listening to Damien. He's across so much information and knits it together so well. Just to say that next week, I'm going to be joined in the studio, no less, by Steve Keen. And we're going to talk about the economic imperatives and the political imperatives ahead of the election. So that'll be an interesting conversation. So join us there and ask a question live of Steve. Of course, Steve will be able to talk about his housing policy, but also more generally about what he sees economically as well. So that'll be worthwhile. Just before I close out, just to highlight the fact that the dogs are still asleep. They've hardly moved all evening, but obviously we're listening intently to what we were saying, so that's probably why they're sound asleep. And I want to say thank you very much for spending some time with us this evening. Check out our shows during the week and check back next Tuesday for our next live show. Have a good evening, keep safe, and I look forward to the next one. This is Martin North from Digital Finance Analytics, signing off. Cheerio.